Okay guys, this is the last one on finance, I'm glad to say, because I'm sick of the droning nature of my own voice. One thing, I kind of ran out of time in the last one, so apologies for that. I meant to make this guy a limited company just for the sake of the equity angle of things. Yeah, and because I was showing retained profits and stuff over here. Anyway, profit and loss account / income statement for RB's headphones, and then we have a balance sheet. I mentioned earlier that the profit and loss account or income statement tells us about the performance of the business, whereas the balance sheet is all about the value. In other words, notice that this document is for the year ended, ended on this date, whereas the balance sheet is not for the year ended, but as at 31st of the 3rd, 2015, this specific day. Because, obviously, today, RB has got £35,000 worth of stock in his shop. But if he has a good day, then maybe he'll only have £32,000 worth of stock at the end of the day. Or 30, or 34, or whatever. And then he maybe has more cash. So these figures will change day by day. And the same may happen here. He may pay off some of his short-term debts, or he may receive another invoice from his suppliers, and that will push that figure up to 70 or £10,000 maybe. So it's quite fluid. So it's really only a snapshot or a short-term still picture of what's going on and what is a very fluid situation with the balance sheet. Okay, so income statement is all about performance. Balance sheet is all about value. Now, let's skip on down to something that people find tricky sometimes, and that is ratio analysis. Now, I've hidden all this stuff over here somewhere, so apologies as I try and find it all. Might be more. There it is. There it is. Okay, so as if by magic it all appears. Right, we're going to first of all, I'll hide this. Actually, yeah, I'll hide all that for now. Yeah. Right, performance ratios. There are only two. Good news. Even better news, you don't have to remember these ratios. You're given the formulas. The gross profit over sales times 100, you will be given that in the exam. You will not have to recall that. You'll just be asked to interpret it. Okay? So what is gross profit margin? Well, it just means gross profit over sales times 100, or gross profit, I should say, over turnover specifically. But anyway, in this case then that would be £107,000 over £250,000. And then whatever that is times 100. In this case, that works out as 43%, which seems reasonably healthy. We'd prefer it to be 50, but hey, I'll go with it. Now, what does that mean? Is that good or bad, or what is it? There's no magic number. This is a problem with these ratios, that it's really a relative term. So you can't say, for example, if EasyJet has, by the way, I'm totally making these figures up. If an airline has figures of a gross profit margin of 15%, and Next has a gross profit margin of 95%, you can't say, oh, Next is far better than EasyJet, because they're totally different business models. They're totally different businesses, and you can't compare them when they're not in the same industry. You have to compare like with like. It's got to be the same industry. So you'd have to compare Ryanair with EasyJet, or Next with Topshop or Arcadia or whoever, that kind of thing. So you've got to compare similar industries. And the other thing is you've got to compare with previous years. So for example, this standalone figure 43% really doesn't mean anything. We need to compare with our competitors, or if in an exam you don't get a competitor figure, they would give you last year's figure. And they'd say, so what do you think about this new figure? And you'd probably have to do the calculation. They'd tell you the ratio here, and they'd expect you to calculate it. And then they want you to comment compared to last year. Now, obviously, last year, if it was 58% and it's now gone down to 43%, then the margin has been eroded. And you'd have to ask why. So if you want to pause the video, you could ponder some reasons why. Okay, if you're back already, well done. Some reasons could be, well, it's going to be one of two things. It's going to be either your cost of sales have gone up, so you had to pay more for your stock, for example, or maybe you're facing increased competition and you've had to cut your prices slightly, so your gross profit margin has been squeezed. Those are the kind of reasons that would happen. We also can look at net profit margin. Again, this ratio is given to you, so all you have to do is put the numbers in the appropriate places and do the math on your calculator. Again, what's a good figure? There isn't really one. You'd have to compare with competitors, and you'd have to compare with the previous year. Whatever the context you're given, whatever background you're given in the exam, that's what you can use. So, in this case, last year, RB had a net profit margin of 20%. That has fallen to 7.6%. What reasons do you think? What reasons could you suggest for this fall in net profit? You can pause the video and think of some answers. Okay, some reasons would be, well, obviously net profit is gross profit minus expenses. So if there's a big drop from one year to the next, it would suggest that either your turnover is down, gross profit is down, so there may be a pattern emerging further up in the or earlier in the income statement. Or it may be that you haven't controlled expenses enough. Maybe RB's rent went up, or he's paying himself too much, or he's taking on more staff, or his electricity bill's gone through the roof, or the council's put up rates, those kind of things. Okay, so you'd have to just look and see what are the reasons for that. But it's really just about comparing with the previous year and explaining what's happened. So that's the performance or profitability ratios. There are only two, and it's not that difficult to really figure out what's going on when you look at these. Do some basic mathematics. Okay, let's go over then and look at the other type of ratios. And again, there are only two more, so there are four in total. I'll just unembolden that because it's a bit obnoxious. Okay, so we have the current ratio and the acid test. The current ratio just means, can you pay your short-term debt? Right? That's what liquidity is all about. Do you have enough cash to pay your short-term debts, your bills? Don't call them bills in the exam. Please call them short-term liabilities or current liabilities. How do you calculate it? It's really current assets divided by current liabilities. Now, it's not a percentage this time. Over here we have percentages. But this time it's expressed as a ratio. So in this case we have a very, very liquid company. Now, again, I kind of made these figures up, so I wasn't thinking too much about what liquidity ratios and stuff would come out of it. But generally, that's pretty high. I mean, if you have 10, this is essentially telling me that I have 10 pounds, or RB rather, RB has got 10 pounds of short-term assets for every 1 pound of short-term debt. 10 to 1. Now, that is very liquid. He should have no cash flow problems. He shouldn't really need an overdraft if he's got that kind of liquidity, which again has some positive benefits because it means he wouldn't have to pay 20%-ish interest on an overdraft. So that can be a good thing. It may be a downside though, because you may say, well, if he's got that much cash lying around, then why? Why has he got so much money tied up in short-term assets? Maybe he should hold less stock, okay? Because, you know, if it's all just sitting there on the shelves and he's not selling it quickly enough, then maybe that's not the best use of the money. Maybe he could invest in bigger premises or some kind of maybe marketing campaign to boost sales or something like that. You know, the money could be better employed somewhere else in the business. So you can't have too much of a good thing. You can't have too much cash. And if you've got too much cash lying around, then you have to think, well, is it getting a great return just sitting there? Because it's unlikely, even if it's cash in an interest-bearing account at the bank, it's only going to be getting between 1% and 3%. Whereas if he invested it in his business, he could maybe get a much higher percentage return. Look over here, he'd be getting 7.6% maybe, or something like that. Okay, so that's, can he pay his short-term debts? Yes, he can, and then some. Yeah, okay. One thing we need to consider though is, what about last year? Because unlike with the profitability ratios or performance ratios, often we will have to compare with previous years, but you may just be given a standalone question where the exam could just read, comment on the liquidity of the business, or is this high, is this low, whatever. You have to give some kind of comment. In which case you would suggest that, well, anything over about 2 to 1 is pretty great. Okay, if it's over like 1 pound, this is last year it was 1.5 to 1, which just means he has £1.50 of short-term assets for every pound of short-term debt, which is healthy. If it's 2 to 1, so £2 of short-term assets for every pound of short-term debt, that's even better again. Once you get beyond that, you need to think about whether you're really using your cash that effectively. Now, acid test is a stricter test of liquidity. Because what we're doing is we're taking stock out of the equation. Now, for a business like RB, he maybe, let me just zoom out slightly. RB's is maybe not a business where he'd have to worry about shifting his stock. I mean, what does he do? If he has to sell some stock to pay off his overdraft or pay his suppliers, and they're all haranguing him at the same time, they're on the phone saying, RB, you haven't paid me for those headphones, man. You're 3 months overdue. Give me some money. Then he can probably just have a sale and sell off the stock relatively quickly, maybe in a day or two, and get that cash together, and then pay off the suppliers or whoever he owes the money to. But there may be situations where maybe like a civil engineering firm, or maybe a firm that makes cruise ships, or maybe a firm that sells luxury yachts. They can't just have a sale. They can't just say, oh, hey, our luxury yachts, or our helicopters, or our Thales air defense missiles are 20% off all week. It's just not that kind of business where you're going to have people queuing up to buy them just because they're on special. So in that case, then, what you have to say is, look, what if we couldn't sell our stock? What if we disregarded any stock that we have? So with the acid test, what you're doing is, let me just zoom in again because it seems a bit far away now. With the acid test, what you're saying is, right, if we took stock out of the equation, could we still pay our short-term debts? In this case, the picture has changed significantly. It's gone down from 10 to 1 to 3 to 1. Now, it's still very healthy. Okay, anything over 1 to 1, realistically, in an acid test is pretty spot on. As you could pay your short-term debts without worrying too much. If you can kind of match it parity 1 to 1, then you're pretty safe. The worry would be if you were much below that. Last year he had liquidity of 0.8 to 1, which was maybe a little bit of a worry that if he hadn't been able to shift his stock quickly, maybe just no one's buying headphones this week for whatever reason, and he might have struggled to pay off his overdraft. He might have struggled to pay off his creditors, his trade payables, as we now call them. But as it turns out, things have much improved. He's now got 3 to 1 ratio. So he's got £3 of short-term assets without his stock. So in terms of stuff he already sold, let's just scroll up and have a look. So stuff he already sold, right, his trade receivables, plus cash in the bank, he's already got 3 times the level of his short-term debts. Okay. He's got that in 3 times the level of his short-term debt. So he's fine. He's absolutely fine. Okay, more than enough. Again, the only issue he has here when we look at these figures is it too much? 1 to 1-ish is a target. For the current ratio, 2 to 1-ish is a target. Once you get much beyond that, then you're maybe thinking about, well, have you got too much money tied up in stock? Is there too much cash lying in your bank account? Which again is a nice problem to have, but it may not be getting the return that he could generate if he invested his money in the business. Okay, that feels like pretty comprehensive look at ratio analysis. Any questions, Gmail me, call in to see me before your exam.